So as I was telling you that when we look at this chapter, you have one portion or one question coming from the part that we have already done. Then you definitely get one question from financial planning. So financial planning is a standalone topic, but it carries a lot of weightage, and you usually get a 3 to 4 marker question from here. So what exactly is financial planning? So we have done planning earlier, and we know that planning means the blueprint of a company. Similarly, when we talk about financial planning means the financial blueprint of a company. So what is financial planning, Bache? Financial planning is preparing the financial blueprint of a company. Financial planning helps the company to bridge the gap between financing decisions and investment decisions. I'll take you to the previous slide rather. Here we have what is financial planning. So what is it? It is deciding it. So basically there are two things that we talk about in financial planning. Financial planning is concerned with estimating the requirements of funds and making them available as and when required. I repeat, it is concerned with estimating the requirement of funds as it what amount of funds and at what time will it be available, and making them available as and when required. Okay, so you can see it is determining the amount of funds required. It is determining, to a certain extent, it is determining the source of funds and determining the policies. I mean, you can leave this over here, determining the amount of funds, determining the source of funds. So that is what financial planning is concerned about. तो बिल्कुल छोटे में अगर आपको बोलना है, short and crisp, you will say financial planning is concerned with determining the amount of funds, the timing of funds, and making them available as and when required. Now, when we talk about financial planning, there are two objectives. We say there are twin objectives to financial planning. And what are those two twin objectives? The first one is to ensure the availability of funds whenever they are required, like I told you. So whenever planning is done, financial planning is done, all the time periods where the funds will be required and the quantum of funds, that means the amount of funds which will be required, it is all estimated. So that is the first part, ensuring the availability of funds as and when they are required. So first it is estimated and then it is made available. And the second thing is to ensure that there is no idle funding, IDLE. In other words, you can say to see that the firm does not raise resources. Now, when I'm talking about resources, we are just talking about funds over here because we are talking about financial planning. So to ensure that there is no idle funding. And then what is idle funding, boys and girls? Idle funding means the funds should be just enough to cover up or as per the requirement. So the funds available should be exactly as per the quantum of funds required. Because if funds are surplus, then the opportunity cost will be lost. And if the funds are less, then the objective will not be achieved. The point or the purpose for which the funds are required, it will not be accomplished, right? So twin objectives of financial planning is first to ensure that there is availability of funds as and when required. And second, to ensure that there is no idle funding. Only two objectives. Moving on to importance of financial planning. So अब इसमें आपको ध्यान रखने की चीज क्या है? In importance of financial planning, there are no head points. There is no heading. So it's straight statements. So in this slide, you can see on the screen that the headings are given. But when you write your answers, there is no need to write the headings. So it comes as a straight statement, simple statements, two-liners. So what is the first importance? It makes the firm well prepared to face the future, or it helps the firm to face the future. Now, what is it? Whenever plans are made, plans are made taking into estimation or for forecasting the future situation, and not a single plan is made. There are always multiple plans, plan A, B, C, D, A, and so on. That means situation is analyzed and all the ifs and buts are taken into consideration, that what or how will the plan change if the situation changes like this, or what will be done if there is a certain different situation. Like you can see an example over there, and this has been quoted in the questions again. So if the firm is expecting a 20% growth in sales, there are chances that the growth in sales may be 10% or maybe 30% also. That means आपका estimation से ऊपर या नीचे भी जा सकता है. In that case, the financial planners are going to make 3 financial plans, one for 20%, one for 10%, and one for 30%. 30%. Now your question may be, you might be thinking, कि जरूरी है कि 10% का difference हो. No, this is a hypothetical situation. So difference may be of 2% also. What we want to convey over here is that we are expecting 20% growth in the sales, but it may be less or it may be more. So if it is less, what will be done? If it is more, what will be done? So these are all plans are ready, and as the situation changes, the plans are also switched. And that is why we say that financial planning helps or prepares a firm to face the future. जैसे future change होगा, जैसे condition change होगी, हमारे पास उसके accordingly plan ready है. Why? Because we can't handle or change the situation, but we can change our plans. Then second is it helps in avoiding business shocks and surprises by preparing well in advance as to what is the volume of funds required, as when it is required, and estimating the sources of funds which will be used. The financial planning helps business avoid all shocks and surprises because the estimation is already made कि कहाँ कब कैसे funds की जरूरत पड़ेगी, कहाँ inflow होगा, कहाँ outflow होगा, कहाँ पे funds कम कर पड़ेंगे, कहाँ पे readily available होंगे, हम क्या source कहाँ use कर सकते हैं. तो ये सिर्फ already planned होता है, तो there is no shock or surprise to the business. Third is helps in proper utilizing of finance. We just talked about no idle funding. So this is optimum utilization of funds. Funds are made available exactly as in the same volume as they are required. So there is optimum utilization of financial resources. Then third is helps in coordination. Now, how does it helps in coordination, beta? Because every function of management, every function, whether it is planning or it is organizing, everything runs on money. Money is the blood that makes, flows in the business. So since everything, every department knows what is the volume of fund which will be made available to them, they coordinate with each other. So it helps in coordinating the fund different productions or different departments by making it very clear as to what will be the kind of funds which will be available to them and at what points of time. This is really important. The link. Financial planning acts as a link between investing and financing decisions. So investing decisions are पैसा लगाना कहाँ है, financing decisions are पैसा लाना कहाँ से है. So financial planning acts as a link between these two, right? Because I told you that it is all about estimating the requirement of funds. That means पैसा कहाँ से कहाँ लगाना है हमें, and making them available. Making them available is financing activity. Then we come to, it links the present with the future. How does it link with the present with the future? Because financial planning is done in the present, but it is always done for future. Planning is always for future. So it links the present, that we are making estimates and budgets and blueprint as in the present, and we are going to make it available in the future. So it links the present with the future. Now, my dear boys and girls, when you write your answer, आप लिखेंगे heading आया, ये आपका statement आएगा. Financial planning links the present with the future as financial plans are made in present but are executed in future. बस खत्म, कोई heading नहीं, कोई explanation नहीं. Similarly, financial planning acts as a link between the investing and financing decisions. You can open up your book and you can see there are just one-liner statements given as far as financial planning is concerned. Okay. So I repeat, this topic comes for 3 to 4 marks. What is financial planning? What are the objectives? There are twin objectives of financial planning, and what is the importance of financial planning? 3 to 4 marks का question यहाँ से आता है, so अच्छे से कर लेना. Moving, this is not in your syllabus, so we'll not take this. Now we move on to capital structure. So there are two important things that we are going to cover over here: capital structure and financial leverage. So what is capital structure? You have done it in accounts also. So when you look at it, capital comprises of two major things: owners' funds and borrowed funds. And capital structure is all about the quantum, or you can see the proportion of debt to equity. So capital structure is nothing but the combination of owners' funds and borrowed funds. So it is denoted as debt upon equity. I'm not going to go into the details of debt upon equity. We have been doing it since grade 11. So it is just a combination of debt to equity. So you can see here financial leverage. So when I say, I'll take you back to the last slide. So when I say capital structure, I can write it like this: debt upon equity, or it can be written as debt upon debt plus equity. That means the proportion of debt to equity, or it can be the proportion of debt to the total capital employed. This is capital structure. As to what are we going to? And we know that ideal debt equity ratio is 2:1. You can mention this, that ideal debt equity ratio is 2:1. That means debt is twice of equity. Moving on to financial leverage. But before I come on to financial leverage, I take you to the factors affecting capital structure. Now, when I talk about factors affecting capital structure, you need to understand that maximum points that you have done in financing decisions, you can take the same points over here. I repeat, the points that you have done, the factors affecting financing decisions that we did yesterday, and there were the code I gave you, there were 7 factors that we did. All those 7 factors can be covered up over here. Why? What is financing decisions? It's making a choice between debt and equity. What is capital structure? Capital structure is again about making a choice between debt and equity. So the points which are common, I am not going to explain them again, but I'm going to tell you. So cash flow position is a common point, right? Cost of debt, we did it as cost. If you remember, we did cost over there. So this is again the common point. So this cost of debt and cost of equity, these two have been combined as cost over there. We also did flotation cost. This is the third common point. Then control we did. This is another common point. Regulatory framework. If you remember, we did something called as legal constraints. अच्छा वो हमारा dividend structure उसमें आया था factors में. So regulatory framework, okay, I'll cancel this out. Regulatory framework हमने नहीं किया. Then this is different. स्टॉक मार्केट कंडीशन भी हमने किया है जहां तक मुझे ध्यान है. स्टेट ऑफ कैपिटल मार्केट, yes, we have done state of capital market. So this is also a common point, right? So there are so many common points that you can pick exactly from factors affecting financing decisions and use over here. So it should not be overwhelming to you. तो दो बार learn करने का जरूरत बिल्कुल भी नहीं है, because whenever you're asked a question onto factors affecting the choice of capital structure for 6 marks, let's say, you just have to write 4 points in that. Heading and explanation, just 4 for 1.5 mark each. So these points which I have covered, I'm not going to take. The others I'm going to quickly explain. So what is interest coverage ratio? Interest coverage ratio tells as to how many times a firm is able to cover the interest out of its earnings before interest and tax. The higher the ratio, the more the credibility of the company and the more the satisfaction of the lenders. So it is calculated as, ICR is calculated as EBIT, earnings before interest and tax, upon interest on borrowed funds, right? So it tells, and it is calculated in the number of times. So let's say it comes 4 times. That means a company has the capacity of paying the interest on borrowed funds 4 times. That means a company has a high credibility, and so funds will be easily available. So if ICR is high, the company will be able to raise debt funds or debt capital very easily. Then comes return on investment. Now, what is return on investment? The return that anybody gets by investing the capital. And when I say capital, I'm talking about total capital employed in the company. Now, it's very simple. If ROI, and this again, I'll be covering in financial leverage. If return on investment, which is ROI, is more than return on debt, or you can say interest on debt. ROI is more than return on debt or interest on debt. In this case, there should be more debt capital. The debt should be high and equity should be low. I repeat, agar return on investment is more than return on debt, that is the interest on borrowed funds. In that case, borrowed funds become a cheaper source of finance, and therefore there should be more debt financing as compared to equity. Then moving on to tax rate. Now, what is this tax rate? If the tax is high, and we know that interest on borrowed funds is a tax deductible, it is tax deductible. So if the interest tax is high, income tax or the tax rate is high, then the firms will prefer taking more debt because there will be more concession they will be getting. So higher tax means preferring debt, whereas lower tax rate means having less tax. I repeat, Interest on borrowed funds is tax deductible. That means no taxes to be paid on interest on borrowed funds. That is why if the tax rate goes high, the company gets more benefit by using debt financing, and therefore debt is more and equity is less. Cost of equity, I told you that cost of debts and cost of equity we have covered, flotation cost we have covered, we are not going to take that again. Risk consideration. Ab risk to सीधी सी बात है, there is more risk involved in debt financing as compared to equity. Equity में कोई risk नहीं होता है, but in debt financing in borrowed funds there is risk involved. Why? Because there is interest which has to be paid and there is redemption, that is repayment of the debt also. So if the financial risk of a company is already high, then a company should not unnecessarily increase it. That means as the debt capital increases, the financial risk of a company also increases. So this can be asked for 1 marker. What do you mean by financial risk? Financial risk is a condition where the company is unable to meet its borrowed funds or unable to meet its financial obligations. I repeat, financial risk is a situation when the company is unable to meet its financial obligations. So as debt increases, financial risk also increases. Therefore, a company should keep a check on this financial risk also. Unnecessarily increasing the financial risk may lead the company into trouble. So what happens? There is a saturation point. A point aisa aayega where the company needs funds or borrowed funds. The market condition is not favorable and borrowed funds is the only available option. But because the financial risk is already too high, the company will not be able to raise funds. So this should be taken into consideration. Then comes flexibility. Obviously, borrowed funds is a much flexible source of funds as compared to equity, because equity is a permanent source of capital. एक बार raise कर लिया तो permanently invested रहेगा. But borrowed funds can be raised as and when required. Also, borrowed funds are available under all kinds of economic conditions. In boom, it is available. In depression, it is available. In consistent situation, it is available. So debt हर समय available रहता है. So it can be raised and repaid as per the requirements of the firm. That is why it is a more flexible source of finance. Okay. Control we have already done. कि control remains in the hands of the equity shareholders. So इसलिए अगर tight control चाहिए तो debt issue होगा as compared to equity, because equity leads to delusion of control. Regulatory framework. Now, what we do mean by regulatory framework? A company cannot just get up and issue securities, whether shares or debentures, whatever. It has to take permissions from SEBI, the watchdog of the securities market. So the company has to follow the guidelines, the rules and regulations set by SEBI before going on with owners' funds or borrowed funds. So in simple words, the guidelines, the laws, the rules given by SEBI need to be followed, and SEBI approval is required before issue of securities, whether it's owners' funds, that is shares, or debentures. Then coming on to debt service coverage ratio. Now, ये क्या है? इंटरेस्ट कवरेज रेशियो और डेट सर्विस कवरेज रेशियो अलग से पढ़ लेना. आज तक तो मैंने अलग से इसका क्वेश्चन देखा नहीं है, बट बिकॉज दीज आर द टू थिंग्स व्हिच आर अ लिटिल डिफरेंट फ्रॉम द अदर्स. सो व्हाट इज दिस? वी से दैट दिस रेशियो, डेट सर्विस कवरेज रेशियो, इज एन एक्सटेंशन of ICR, that is interest coverage ratio. Now, interest coverage ratio says EBIT upon interest. Now, this ratio says that even though the earnings before interest and tax of a company are high, the money may still be tied up in non-current assets. That means fixed assets. In other words, the liquidity condition of a company may not be very good. So in order to find out whether the company will be able to pay, because interest, my dear boys and girls, is paid in cash. So that is why DSCR, debt service coverage ratio, is calculated. And the formula is we take profit after tax over here. Okay. So we take profit after tax. We add the interest back. We add all non-cash expenses like depreciation back. Why? Because when we come on to calculation, आप लोगों ने किया हुआ है ट्रेडिंग एंड P&L अकाउंट, जितने भी नॉन कैश एक्सपेंसेस होते हैं, जैसे डिस्काउंट अलाउड इज नॉन कैश, डेप्रिसिएशन इज नॉन कैश, बैड डेट्स इज नॉन कैश, right? But we show that on the expenses side column of our trading and P&L account. So सारे non cash expenses को वापस add on कर दिया जाता है. Why? Because it unnecessarily decreases the profit. So the formula is profit after tax. Interest is added back because we have to take interest in the denominator also. Plus or add back all non-cash expenses upon preference dividend. Why preference dividend? Because preference dividend is an obligation. It has to be paid. Okay. It's fixed and it has to be paid. Only equity dividend is something कि आप pay नहीं करोगे. Then interest on borrowed funds plus repayment obligation. What is repayment obligation? Whenever loan is taken, whenever debentures are raised, they have to be redeemed also. You have done entries for raising of debentures. तो उसकी जो second entry करती है उसमें ही हम redemption condition का entry बनाते हैं कि what is the condition of redemption? Raised at par and redeemed at par, or raised at par and redeemed at premium. You have done those 6 conditions. So loans have to be redeemed also. So the formula is profit after tax plus interest plus non-cash expenses upon preference dividend plus interest on borrowed funds plus repayment obligation, if any. Very simple. If DSR is high, it means the credibility of a company is really high and such companies will get a loan very easily. इनको debt financing में कोई issue नहीं आएगा. And the last one is capital structure of other companies. It is not the companies, it is other companies. So whenever a company looks or starts with its capital structure, it always goes back and looks at what is the kind of capital structure with the competitors. Industrial norm क्या है? For example, अगर आप एक नया स्कूल खोलते हो आज, तो उसकी फीस सेट करने से पहले आप देखोगे कि यार बाकी स्कूल्स की फीस क्या है. अपने नंबर ऑफ एम्प्लॉइज करने से पहले आप देखोगे बाकी स्कूल में टीचर स्टूडेंट रेशियो क्या चलता है, कितना स्टाफ है उनका, कितने स्टूडेंट्स पे. सो सिमिलरली व्हेन वी टॉक अबाउट कैपिटल स्ट्रक्चर ऑफ अ कंपनी, द कंपनीज मे लुक एट द काइंड ऑफ कैपिटल स्ट्रक्चर व्हिच प्रिवेल्स इन द इंडस्ट्री. हाउएवर, इट शुड बी taken into consideration that no such a structure can be blindly followed. You can, the managers, the financial managers, the financial analysts, they do study the capital structure of other companies, but then they make their own choice, keeping into consideration any or all of these parameters. Okay, I repeat, when you do factors affecting financing decisions, you are automatically doing factors affecting capital structure. इसलिए बहुत ज़्यादा उसमें आपको intrigued होने का ज़रूरत नहीं है. Now I'll take you to financial leverage. Now, what is financial leverage? I do have 4 minutes. We'll start with this. So what is financial leverage? अभी मैंने आपको क्या बताया था? What is capital structure? Capital structure is proportion of debt to equity. It's exactly the financial leverage. So financial leverage is also the proportion of debt to equity or to overall capital. So the formula that I gave you over there, debt upon equity. So this is proportion of debt to equity. So if I say my debt is, I gave you the ratio 2:1. Gitali, can you mute yourself? Yeah. So when I told you 2:1, so that means my debt is 2 and my equity is 1. So let's say 2 lakhs and 1 lakhs, or 2 crores and 1 crores. Or it may be debt upon overall capital, that is debt plus equity. So let's say my total capital is 3 crores and out of that 3 crores, 2 crores is my debt. This is financial leverage. अब जब हम financial, so again, what is financial leverage? Financial leverage is the proportion of debt to equity or proportion of debt to total capital employed. Okay. So same है capital structure का और financial leverage का. Financial leverage can be of 2 kinds. It can be favorable financial leverage or it can be unfavorable financial leverage. Now, what is favorable financial leverage? Favorable financial leverage is a condition जो मैंने आपको बताया था when return on investment, ROI, is more than the return on debt. I write it as ROD. So when the return on investment is higher than return on debt, it is called as favorable financial leverage. And when there is favorable financial leverage, trading on equity takes place. So again, I kind of have a hunch you are going to get a question on financial leverage this time, right? So financial leverage is the combination or the proportion of debt to equity or to overall capital. A favorable financial leverage is a condition when return on investment is higher than the return on debt. However, when this is in reverse, when return on investment is lower than the return on debt, it is called as unfavorable financial leverage. And in this case, if trade on equity is done, then the EPS decreases. So I'll go back to this point. So in case of favorable financial leverage, trading on equity is done. And what is trading on equity? Trading on equity is raising debt. Debt को और बढ़ाना. Raising debt in order to raise EPS, debt बढ़ाया जाता है ताकि EPS, that is earning per share, भी बढ़ता चला जाए. In the next class, I'm going to take a numerical on this trading on equity because it does come as a numerical portion. So two concepts. One is financial leverage. Financial leverage is a situation when the return on investment is higher than the return on debt. In simple words, if a company raises borrowed funds, let's say at the rate of 10% per annum, and by investing these funds in profitable projects, it can earn more than 10%. It is a situation of favorable financial leverage. When there is favorable financial leverage, trading on equity takes place. Trading on equity is a situation when the company increases its debt as compared to equity. It is done for two reasons. One, the interest on borrowed funds is less as compared to the return on equity. Second, that it is tax deductible. So the benefit of tax deduction goes to the company. And this helps in increasing EPS. So Shrey, to answer your question, what is trading on equity? Trading on equity is a situation when the company increases its borrowed funds or debt financing as compared to equity. It brings two advantages to the company. One, the interest on borrowed funds is fixed and pre-decided. Second, it is tax deductible. So it helps in increasing the EPS. Okay, that is earning per share. Is that clear?
Yes, ma'am.
All right. So now I'll be sharing my whiteboard and I'll be taking one numerical over here so as to make it very clear what exactly is trading on equity and how do we go about. I get back to where I was. So if you remember, what did we say? That the company already had equity share capital of how much, bache? It has 10 lakhs as the equity share capital and it is into shares, equity shares of 10 each. It wants to raise a further capital of 5 lakhs and it has an option to either go for equity financing or it can go for 10% per annum debt. It is also given that the return on investment before this expansion was 4 lakhs and the tax rate is 30%. You have to advise the company whether to go for option A, that is equity share capital, raising funds through equity, or should it go with debt financing? You have to suggest that. So what are we going to do? You will have to do it through a table. And how do we go about this table? This is my option A, and this is option B. My God, what a beautiful handwriting. Don't compare it with my actual writing. My actual writing is much better than this. Okay, so when I talk about option A, we have equity share capital. In option A, we are saying that 10 lakh is already there. The rest 5 lakh will also be raised through equity. So it is 15 lakhs. In option B, 10 lakh is equity. And the other 5 lakhs is going to come from 10% debt. So your total capital employed is 15 lakhs here and the same 15 lakhs here also. This is your total capital employed. Now, the first problem or the first error that students make is, isi ko aage calculation ko le jate hain. Please close this. This is your total capital employed. Okay, a combination of debt and equity. Now, what you are going to take? Earnings before interest and tax. Now, what is given to us that the earning was 4 lakhs on 10 lakhs? Can you tell me what is the rate? How much percent does that become?
40%, right now?
Absolutely. It becomes 40%. And how did I calculate that? 4 lakhs upon 10 lakhs into 100. So it becomes 40%. That means my rate of investment, return on investment, sorry, was 40% on 10 lakh. Now my total capital employed becomes 15 lakhs. So 40% of 15 lakhs comes to, can anybody give me? It comes to 6 lakh. So this is another mistake that students make. Please read the language carefully. If the question is telling you that 4 lakh was the return before this adjustment was made, and the company expects to earn or have a return on investment at the same rate. So at the same rate, that means at the rate of 40%, 40% into 15 lakh comes to 6 lakh. So this is my EBIT. Now it is earnings before interest and tax. So what are we going to reduce now? Interest. So minus interest. In case A, there is no debt financing. So there is no interest. However, in second case, 5 lakhs is my debt capital and 10% is the return. So 10% return means 50,000 will be the interest paid. 5,50,000. What is this? This is earnings before tax minus tax. Tax rate is given to us at 30%. So 30% of 1,60,000 comes to 1,80,000. And that of 5,50,000, I'm using my calculator. It comes to 1,65,000. Just cross check, please. So I am left on with 4,20,000 here in this case, and we are left on with 3,85,000 in case B. This is earnings after interest and tax. Okay. Now what you have to calculate? You have to calculate EPS. Pura game hi EPS ka hai. Now, abhi tak, if you look at it, you will feel that option A is better because earnings after interest and tax is higher than the option B. But when I calculate EPS, EPS is equal to earnings after interest and tax upon number of equity shares. So 4,20,000 upon what is the total number of equity shares, because my total capital over here is in equity and it is at the rate of 10 each. So I have 1,50,000 shares in option A. In option B, 3,85,000 upon the total equity is 10 lakhs, and so the number of shares becomes 1 lakh. Please give me the answer. 4,20,000 divided by 1,50,000. It comes to 2.80 per share. And in this case, it is very clear. It will come as 3.85 per share. Now you can see that EPS in option B is 3.85. It is much higher as compared to option A. Why? Because option B used debt financing. This is the concept of trading on equity. So your earning is 40%, return on investment is 40%, whereas return on debt is only 10%. So trading on equity is giving a benefit. Also, boys and girls, please make a complete note that if your equity and debt is equal, if the ratio is 1:1, then the results will be disastrous, because we never talk about equal. We always say that debt should be more than equity. Equal की बात नहीं होती है. So equal अगर आप कर दोगे तो आपका आंसर बिल्कुल गलत हो जाएगा. So you may be given a question like this, or you may have to take your own figures. So when you take your own figures, you can take these figures or you can take some other figure also. But I have a feeling that you are going to get a question on this. I'm taking the common pointers, beta. Common pointers affecting the fixed capital and the working capital requirements of a company. So this, makes the things easier to understand, because if you get a question that you have to explain any factors, it is absolutely your choice which factors you're going to pick. And so it becomes, very easy if you take the common pointers. So what I'm going to do is, here I have fixed capital. Here I have my working capital. And here I will take the common factors. So first I'm going to take is size of business. Okay. Size or scale, it's one and the same thing. Size of business or scale of business. So it's very simple and easy. Scale or size of business means the level, the volume at which the business is carried on, the scale or the size at which the business is carried on. So if the business is carried on at a large scale, then fixed capital requirements and working capital requirements both will be high. However, if the business is carried on small scale, then the fixed capital as well as working capital requirements will be low. Okay. Second, we take nature of business. So there are two kinds of businesses. One is manufacturing and the other one is trading. In fixed if we talk about fixed capital requirement, the fixed capital requirements are high in manufacturing as well and lower in trading. I repeat, fixed capital requirements are high in manufacturing and lower in trading. However, when we talk about working capital requirements remain high in manufacturing. Why? Because when we are manufacturing, there are stocks of raw materials also required. Raw materials का stock चाहिए है, tools and equipments का चाहिए, loose tools चाहिए, spares parts चाहिए. So the working capital also increases. However, the requirements in trading is lower. So I repeat, if there is manufacturing organization, the fixed capital as well as working capital requirements are high. In trading, both the requirements are fixed capital as well as working capital. Moving on to the third one, technology. The use of technology. So there are two kinds of technology that is used. One is capital intensive. My God, what the writing. And the other one is labor intensive. I'll be more cautious while writing. So if we are talking about capital intensive technology, which is expensive, your fixed capital requirements will be high. However, if the company uses labor intensive technology, the fixed capital requirements will be low. Coming on to the working capital, if capital intensive technology is used, working capital requirements will be low. If labor intensive technology is used, then working capital requirements will be high. So three common factors. Fourth, growth prospects. So growth prospects, that means if there are avenues for growth and expansion, further investment available in profitable projects. So if growth or prospects are available, yes, then fixed capital requirement will be high, working capital requirement will be high. And if there is no such prospect, then both these requirements will be low. Okay. Then diversification. If a company wants to diversify into certain projects, certain new things, certain new product lines, then both the fixed capital and the working capital requirements will be high. And if there is no such diversification plan, then both these requirements will be low. So these are the 5 pointers, which are the common pointers you can use in both fixed capital as well as working capital. अलग से आपको याद करने का जरूरत नहीं रहेगा. Having said that, I will cover up the other points as well. So nature of business we have done, scale of operations we have done, technique of production we have done. Now coming on to technology upgradation, and remember we are talking about fixed capital requirements over here. So if a company uses a technology which requires constant upgradation, then obviously the investment will also be high. So fixed capital investment will increase if constant continuous upgradation is required. However, if it is not so, then less fixed capital will be okay. Then growth prospects I have done, diversification I have done, availability of finance and leasing facilities. If the company has availability of finance, that means it can borrow the funds from others, or the fixed assets can be taken on lease, that is a long-term rental arrangement, then obviously the funds will not have to be blocked in. So if funds are, like for example, if you're going to buy a car, or hire purchase system is available, 0% finance is available. So अगर financing के alternatives available हैं, या lease financing के options available हैं, तो इस case में fixed capital will be less. However, अगर finance means loan. If loan facility is not available, then obviously more funds, more fixed capital will have to be blocked in. Level of collaboration or joint ventures. कोलैबोरेशन का पर्पस ही ये होता है कि जितने भी रिसोर्सेज चाहिए वो पूल हो जाए, डिवाइड हो जाए, राइट? सो if there is possibility, or if there is a collaboration option available, or the firm is working on a joint venture mode, then the fixed capital requirements will be low. But if there is only an individual organization, individual company working, and there is no collaborations available, the fixed capital requirements will be high. इसीलिए आपने देखा होगा आजकल इंस्टाग्राम पे और सोशल मीडिया पे भी लोग कोलैबोरेट करते हैं. क्यों करते हैं कोलैबोरेट? बिकॉज कोलैबोरेशन से दोनों पार्टीज को ही फायदा होता है. Then moving on to working capital, I have already explained to you what is it. बस यहाँ पे अगर आप चाहें तो देख सकते हैं there are two kinds of capital, gross working capital and net working capital. Gross working capital means the investment made in the current assets. Like you can see cash, bills, bills receivables, prepaid expenses, inventory, that is your stock. However, when I talk about net working capital, it is the formula that we take. Working capital is equal to current assets minus current liabilities. That means excess of current assets over current liabilities. तो जब भी आप लिखोगे ना, तो please do give some opening lines that what is working capital, and then you go on to factors affecting working capital. Scale I have taken, nature I have taken, business cycle. Now this is important, boys and girls, because people get a lot confused in business cycle and production cycle. ये दो बिल्कुल अलग-अलग चीजें हैं. Recently we had taken a test in our school also. वहाँ पे business cycle was, misunderstood as production cycle. So business cycle refers to the economic conditions of the market. Okay. So business cycle refers to the economic conditions of the market. So in the time of boom, when it is boom, when the economy is in boom, the demand for the products will be high. Therefore, the production will be at a higher level, and hence the requirement of working capital will also be high. I repeat, business cycle refers to two aspects. One is boom and other one is the depression. डिप्रेशन जब होता है, लोग सामान खरीदते नहीं है, डिमांड होती नहीं है, प्रोडक्शन लो रहता है, इसलिए वर्किंग कैपिटल रिक्वायरमेंट गोज डाउन. बूम में पीपल हैव अ लॉट ऑफ परचेजिंग पावर, दे गो आउट शॉपिंग, दे परचेज अ लॉट ऑफ थिंग्स, डिमांड इज हाई, एंड देयरफॉर द वर्किंग कैपिटल रिक्वायरमेंट्स आर आल्सो हाई. Moving on to seasonal factors, ये भी एक चीज लोगों को नहीं समझ आती है. Seasonal factors, if a firm deals in seasonal products, that means goods which sell in a certain season. So when the season is on, demand is high and working capital requirements are also high. However, when it is off season, there is no demand, the working capital requirements also go down. Credit allowed. How much credit is allowed to the trade receivables? यानी आप अपने debtors को, अपने trade receivables को कितना time period allow कर रहे हो? If the time period allowed to the trade receivables or debtors is long, then the working capital requirements are going to increase. So let's say आपके trade receivables आपको 4-4 महीने के बाद payment करते हैं, तो obviously आपको पैसा ज्यादा लगाना पड़ेगा as compared to if they are paying in, every 2 months or monthly. And opposite goes credit availed. Credit availed is the kind of time lag, the kind of lease of time the trade payables, your creditors allow you. So the time period allowed by the creditors to the business firm to pay off the amount for the goods purchased on credit is called as credit availed. If credit availed is high, if this is a longer period, if credit availed is long, working capital requirements are low. So credit allowed and credit availed बिल्कुल inverse, opposite चलते हैं. Then operational efficiency. Now, what is operational efficiency? The efficiency with which the operations are carried on in an organization. कितनी efficiently हम raw material को rotate कर रहे हैं, कितनी efficiently हम अपनी machinery use कर रहे हैं, human resources use कर रहे हैं. So if the operational efficiency of a business is high, the working capital requirements will be low. However, if the operational efficiency is low, the working capital requirements will be high. Availability of raw material. Raw material अगर readily available है, market से कभी भी लिया जा सकता है, तो उसको stock करने का जरूरत नहीं है, inventory maintain करने की जरूरत नहीं है. And so when high level of inventory is not required, आपको working capital भी कम चाहिए. पर अगर हम seasonal goods की बात करते हैं, if I'm talking about let's say sugar industry, where the raw material has to be stocked twice in a year, there a lot of money will be tied up in the inventory, and therefore working capital requirements will go high. Level of competition. अब level of competition आपको क्या कहता है? There are two aspects you can say, take about it. One is given on you. If the level of competition is high, then a company will have to follow a liberal credit policy. Liberal credit policy का मतलब क्या हुआ है? आपको अपने debtors को ज्यादा time देना पड़ेगा to pay back the debts because you're competing in the market. Obviously, the moment the trade receivable cycles goes high, then आपका working capital requirement भी बढ़ जाएगा. Sorry, the lower the trade receivable cycle, the higher the need for the working capital. So remember, when we are talking about level of competition, we are talking about what is the credit period which will have to be allowed and the kind of inventory that has to be maintained. तो अगर competition high है, supply steady रखना पड़ेगा, inventory को बहुत strong रखना पड़ेगा, production cycle continuous रखनी पड़ेगी, liberal credit policy follow करनी पड़ेगी. तो उसकी वजह से आपका working capital requirement बढ़ जाएगा. Inflation हम सब जानते हैं, inflation means when the prices of the commodities are rising. So obviously, when there will be inflation, working capital requirement will be high. And if there is no inflation, so working capital requirement kam rahega. Growth prospects we have covered, technology we have covered, production cycle. I told you business cycle, now we come on to production cycle, beta. Production cycle is the time period taken from acquisition of raw materials and converting them into finished goods. I repeat, it is the time period taken or the lag between acquisition of raw materials to conversion of these raw materials into finished goods. The longer the production cycle, the higher the working capital needs. The quicker the production cycle, the less the working capital needs. ठीक है, जितनी जल्दी प्रोडक्शन साइकिल कंप्लीट हो जाएगी उतना ही इन वर्किंग कैपिटल कम चाहिए होगा. और जितनी लंबी प्रोडक्शन साइकिल चलेगी, बिकॉज इट्स अ कंटिन्यूअस प्रोसेस, इनपुट्स तो कंटिन्यूअस जाते ही रहेंगे, उतना ही वर्किंग कैपिटल रिक्वायरमेंट भी ज्यादा जाएगा. And that's it. With this, we come to the end of this long and lengthy chapter.